Hello and welcome to the Tax Roundup for September. This month we take a look at the exposure draft on the super guarantee charge and whether the reforms will actually make the charge fairer. We go to Parliament to have a look at the tax cuts for unincorporated entities and some of the other reforms that are applicable to small business entities and where they're up to. Then David looks at the warning from ASIC on limited licences for self-managed super funds. Finally, Ray takes us through the new data matching program from the ATO, targeting people on foreign visas. Straight across to Mike now to have a look at that super guarantee charge exposure draft.
Now this month we've seen the release of some exposure draft legislation dealing with some changes to the super guarantee charge system. Now this addresses a number of complaints that people have had with respect to this system for quite a while now, so really positive step forward. The exposure draft legislation contains three main changes. The first one is aligning the bases that we use to do SG and SGC calculations. When you're calculating someone's basic superannuation guarantee amount, we need to calculate that based on their ordinary time earnings. However, if the super guarantee amount isn't paid on time, we move into the SGC system, the super guarantee charge system, and the base for the calculation is not ordinary time earnings anymore, it's actually salary and wages. And that is something that could be larger than ordinary time earnings. This exposure draft legislation proposes changing that so that we will always just use ordinary time earnings. So it will do away having to do two separate calculations and trying to figure out where the differences are between those two concepts. So that in itself should make the system a little bit more simpler. The second change looks at interest component. When you miss the super guarantee payment, you're into the SGC system and there is an interest charge that is applied on that. Now, again, that interest charge is being tweaked a little bit so that it will start from the 29th day after the end of the relevant quarter when the superannuation relates to. Now that's different to the way it works at the moment, and in some ways probably seems a little bit fairer because it will just charge interest over the time period that the SGC has been outstanding. So it will continue to accrue until it's actually paid. The third element that changes is there is also at the moment under the current rules a separate SGC penalty amount that can be imposed. That is being replaced, so it's being basically done away with, and it will be replaced by the general penalty provisions under the Tax Admin Act. So again, a little bit more consistent with the way that other late payment, late lodgement penalties are applied at the moment. Now, while all of that's nice and positive, the thing that isn't changing is that SGC will still be non-deductible. So if you pay the super on time, as a business you get to claim the deduction. However, if you miss the timing and you're paying SGC, so under the penalty type regime, the exposure draft doesn't suggest that that will become deductible. So unfortunately, you still miss out as a business on the deduction for the amounts you're paying under the SGC system. The start date that's been proposed for these changes is 1 July 2016. Obviously, you still need to wait and see how things move through Parliament, but good first step, and we'll keep you updated as things progress.
The tax cuts for unincorporated entities have passed through Parliament. Mike's going to take us through the implications of those tax cuts and what you can and can't do, and also look at some of the other small business measures.
Now, we've also seen some further progress around the government's budget measures this month, and that's with the bill that deals with the tax cut for unincorporated small businesses, as well as the extension of the FBT concession around portable electronic devices for small businesses again, as well as the immediate deduction for certain professional costs and other costs that you might be paying in terms of starting up a new business, again aimed at small business taxpayers. Now, the main feature, I guess, of this bill is that 5% tax offset that can be applied to reduce the tax liability of someone who is either a sole trader, who's a small business entity, they're a partner in a partnership that's a small business entity, or the beneficiary of a trust that carries on a business and is a small business entity. That 5% tax offset, remember, is capped at $1,000, so the maximum offset, the maximum reduction in tax liability is $1,000 per individual per year, even if they're involved in multiple businesses. It's a cap that is applied to that individual. Another thing just to be aware of there is if you are dealing with people who operate a business, but they're subject to the PSI rules, the Personal Services Income rules. If they do not pass the Personal Services Income tests, then they will not be able to qualify for this tax offset in relation to their business income. So important to recognise that, because a number of other tax concessions for small businesses can potentially still apply even where someone fails those personal services income tests, but it will not be the case for the tax cut. Now, when it comes to the immediate deduction for certain startup costs, the thing that we need to look at there is, would those costs ordinarily have qualified for a deduction over 5 years under what we used to call the black hole deduction provisions? That's our starting point. So this new provision, it doesn't expand the range of things that are deductible. It just says that certain of those costs, if you're a small business entity, can be claimed immediately rather than being deducted over 5 years. So just remember, when you're working through those rules, we need to come back to those basic rules around black hole deductions. Would they normally qualify? If so, and our client is a small business entity or is about to start a brand new business and they're not connected with any other kind of larger businesses, then costs that directly relate to starting up the business, so professional fees, for example, ASIC fees for setting up their new company, for example, those are the sorts of things that can be immediately deductible. The start date for those measures, whether relate to income tax, is 1 July 2015. So you can expect clients to start asking you questions about some of that. But the real work when it comes to the tax offset, so the 5% tax offset, the real work really comes next year. At the end of this first income year, when we need to start actually working through the calculations, that's when we're going to need to really get into the detail. But the good news is that the bill has passed through Parliament. It's waiting Royal Assent at the moment, but it's almost there. So again, another one of the small business related budget measures that we're seeing come to fruition.
ASIC has given a kick in the pants to accountants this month who have not yet decided what to do about the 30 June 2016 accountants exemption. Now, the issues they've raised here have been that if you're an accountant in practice, they're expecting you to join a license or to start your own financial services license before 30 June 2016, otherwise you will be subject to ASIC regulatory action. That's a quote, what they've said. Now, what are your options? There's a variety of options open to you. One thing they've pointed out is if you want to get your own license, if you want to go it alone, then they require that you put in your application before March 2016. Otherwise, they may not get your application completed by 30 June. Another issue they're indicating is that there will be no extensions on that 30 June due date. If you are undecided, give us a call. We can have a chat about your options. Merit Wealth offers an accountant-centric limited authorisation, but the time for you to consider and decide your pathway is now.
From the ATO this month, Ray is going to take us through that data matching program, looking at people working in Australia on foreign visas.
The ATO have had quite a successful history over the last few years of using information from AUSTRAC and data matching that to individual tax returns, trying to figure out where there might be gaps in a taxpayer's compliance obligations. This has now been escalated with the announcement of a data matching program in relation to information they're going to get from the Department of Immigration and Border Protection. Now, for over a decade, individuals who arrive in Australia on visas with work rights are able to apply for TFNs online, and their proof of identity checks are done through matching with the Department of Immigration's information. If they're here on a visa, they would have already proved their identity. However, this has now been ramped up where the ATO are asking for specific information in relation to a range of visa holders and also their employers and migration agents for a period of up to 4 years. And the details they're looking for is not just the information of the individuals, their addresses, but also their employers, the employer's history, what the payments are, to ensure that those individuals and the employers have been fulfilling all their tax obligations. Now, there is a potential catch there for employers because not only are they looking for things like PAYG withholding and superannuation contribution obligations, but if those individuals have outstanding tax returns, there is a potential risk there for the employers because they may be responsible for any outstanding debts to the Commonwealth. So this is a good time to take a moment to talk to your clients who may have individuals who are on visas and ensure, do they have confirmation that those individuals have actually complied with their Australian tax obligations and filed their Australian tax returns. If not, perhaps as a risk mitigation strategy, they might want to consider engaging the tax agent to provide those services so they have the necessary confirmation if the ATO comes knocking on the door.
And that's the tax roundup for this month. Don't forget, if your firm is not already a member of Knowledge Shop, then take a look at what's on offer. We've got a full knowledge base of updated 2015, 2016 checklists, standards, procedures, pretty much everything you need to make your life in public practice easier. So give Julie a call on 1-800-800-232, and we'll look forward to talking to you soon. See you next month.